It's the tool by which a chip is designed, but also validated. So before you send a chip through the fab to be manufactured, you test that actually the design is going to work. And it's really interesting because Synopsys is a supplier to Nvidia. They use that software platform. The stock's up 5%. Nvidia bought these shares at $414.79. It's now up near $440 a cent, taking between 2 and 3% of the company, replicating a playbook that you and I have discussed with Nvidia a couple of times this year. They took a stake in Intel in what was an engineering partnership. They took a stake in Nokia, which was also an engineering partnership in the telecoms domain. So there is some questions about, well, what does Nvidia get out of this? Synopsys is used by basically anyone that has their own chip designs, right? And so there's an argument that this gives Nvidia a sales channel. Synopsys will say, our software platform is so much better when it's run on Nvidia GPUs. So if you want to use our software to design your chips, you should also use it with Nvidia GPU to power that compute.
It seems like Nvidia, it's almost like an investment business as well as a chip maker. They have stakes in so many other companies.
Yeah.
It's got to be a huge portfolio. Is this part of the strategy?
I mean, we've had the opportunity to discuss this with Jensen Huang several times this year. Every time I've asked him what's the rationale behind taking 2 to 3% of a company, he basically will say, I thought it was going to be a good investment. And particularly in October when we were in DC and they made the Nokia investment, that day Nokia's stock jumped 20% and he almost joked with me, well, I was pretty genius move, wasn't it? His words, not mine. But it's kind of separate from the circular financing debate in that they take equity positions where their bet is that the technology partnership moves the field forward in some way, and they get a return on the stock different to, say, lending money that's discussed in Ian King's Tech Daily today. The circular financing versus backing up loans debate. For Jensen, it's a very simple calculus: is this or is this not a good investment? And they've got some cash to spare right now.
The debate or the story really of last week was Google TPUs and how efficiently they power Gemini and also Gemini versus ChatGPT. John Authors has a great column today wishing ChatGPT a happy 3rd birthday. How does this all seem to be shaking out? Because it seems that that SoftBank's CEO Sun was so sad that he almost cried when he had to sell his Nvidia stake, but he needed the money to invest in OpenAI. Like, what if they're not the ultimate winner?
Yeah, I followed this story from the beach last week because, as you know, I took a break, but it was kind of interesting to take a step back. The very simple argument for those that are still bullish on Nvidia and discount the threat of a Google TPU is that Nvidia is still supply constrained. They will sell every single GPU that TSMC can manufacture for them. And their margins are high, so there's no price pressure. There's no suggestion that Nvidia is having to discount to ward off some of that threat from TPU. TPU is also not that new a thing. I think this is what's so interesting. It's come up in the news flow because Google has started to do deals with third parties. The latest reported one that spooked the markets was Meta, right? But they had previously tried to make the TPU available to third parties with less success. And right now, from a volume perspective, Nvidia still holds 90% of the market, which when I grew up in the Bloomberg newsroom studying from you, that's a technical monopoly, right? And that's an enviable position to be in.
For a variety of high-growth equities in the market, I believe we are about to enter an extremely intriguing moment. With good reason, Nvidia is still one of the most sought-after stocks available. The chips that are mostly driving the AI revolution are the company's high-performance GPUs. Additionally, businesses aiming to handle the most data-intensive jobs will continue to use Nvidia's processors because they are the best in their class, even though some less powerful chips are beginning to garner attention as a possibly cost-effective substitute. It's also true that Nvidia is still a long-term hold for many investors who have stuck with this stock through thick and thin, despite worries that AI spending may be approaching a tipping point where it will have to decline, and other macro concerns about recessionary pressures building. I've been getting more pessimistic lately, too. Let's set aside my general pessimism for a while and examine the bull case for why Nvidia might have additional space to grow in 2026 and beyond. From being a story stock with a lot of potential in the future, Nvidia's perspective has completely changed to one that is now almost exclusively driven by fundamentals. Naturally, most investors will take note of Nvidia's decline after its most recent earnings release, which stunned many in the market given how strong the company's stats have been. In fact, compared to its sales and earnings growth rates, Nvidia's total share price rise has slowed in recent years. In other words, as investors factor in the company's inevitable commercial maturation and some leveling off over time, Nvidia has actually gotten cheaper in recent quarters compared to its current growth pace. However, the news here is undoubtedly Nvidia's latest earnings announcement, which exceeded most analysts' estimates and topped on almost every indicator. EPS more than doubled to $0.78 this past quarter from $0.37 in the same period last year, and Nvidia posted quarterly revenue of nearly $35 billion, 94% higher on a year-over-year basis. These outcomes are still being driven by the staggering demand for Nvidia's GPUs, which are mostly employed in AI, huge language models, and by numerous other cloud computing organizations. But other important markets, including as gaming and automotive, also experienced extremely robust growth, indicating that Nvidia is a vertically integrated tail covering numerous sectors and industries that is worth taking into account in the long run. The management team at Nvidia provides future guidance, which makes up the other half of the beat and raise story. Nvidia is now anticipating Q4 revenue to reach about $37.5 billion, which would translate into very meaningful quarter-over-quarter growth and an acceleration of growth on a year-over-year basis. CEO Jensen Huang and other call participants attributed this guidance increase to the ongoing extraordinary demand for its GPUs. Morgan Stanley analysts recently reaffirmed their overweight recommendation for Nvidia with a $250 price objective. Guggenheim analysts predict that Alphabet may rise much further. With a buy rating, the company increased its Google price objective from $330 to $375. Wynn was recently added to Goldman Sachs analysts' conviction buy list. Because they were never taught that there are two entirely different approaches to wealth accumulation, some investors succeed while others fail. Learn about both here to avoid making the same mistake twice. Markets have generally performed well in December. In fact, the stock market may have seasonal tailwinds in December, which would push it back to its highest levels ever. According to the Stock Trader's Almanac, it has historically been the third best month of the year for the Dow and S&P 500 since 1950, and the third best month for the Nasdaq since 1971, as reported by CNBC. Furthermore, rate reductions remain a possibility, particularly in light of lower than anticipated growth in private sector employment, retail sales, and consumer confidence. Additionally, we firmly believe that the worst of the 2025 volatility is now behind us as investors begin to price in continued profits growth and the excitement surrounding artificial intelligence for 2026. Better yet, analysts continue to upgrade their assessments of the markets. Morgan Stanley analysts recently reaffirmed their overweight recommendation for Nvidia, setting a $250 price objective. The company claims that risks are being exaggerated and that Nvidia will continue to hold a sizable market share. They wrote, as cited by CNBC, "We continue to see Nvidia maintaining dominant market share as threats are becoming overstated, though we aren't exactly sure what will turn sentiment around." Getting enough Nvidia products in general, and Vera Rubin in particular, is the main concern of customers for the upcoming year. With its new Blackwell GPUs expected to account for a larger portion of its total sales, Nvidia hopes to maintain its market dominance over all high-end computing companies as AI compute needs increase. The company also anticipates continued growth in software services revenue, as well as an uptick in adoption. In my opinion, the odds are in favor of Nvidia's stock reaching a new all-time high in 2026. Spending from mega-cap companies does not seem to be set to stop just yet, despite investors' rising caution about valuations and prospects for future growth in light of consumer weakening and a recent breakdown in general mood. In addition to being a key component of the majority of significant indexes, Nvidia continues to be a key component of the narrative surrounding AI infrastructure. As a result, Nvidia stock may be disproportionately supported by capital flows into the market as a whole, giving investors even more motivation to hold on to or increase their exposure to this high-growth mega-cap tech firm over the coming year. as PaleBlue.ai attempts to obtain almost $300 million in funding to purchase cutting-edge Nvidia chips for use in a Tokyo data center, investors are keeping an eye on a new development in the AI supply chain. According to people with knowledge of the situation, the Silicon Valley company has been in discussions with banks and private credit funds for months, with JP Morgan assisting in the preparation of lender papers despite the bank's potential withdrawal. Instead, than using mainland China, Xiaohongshu, popularly known as Red Note, would use Japan to access the chips. Nvidia, Xiaohongshu, and JP Morgan have not responded to the talks, and the business contests the veracity of the material provided. The huge intersection of this possible agreement with Washington's tightening regulations on the flow of high-end U.S. semiconductors to mainland China-based companies is what makes it noteworthy. Due to these limitations, Chinese platforms have been forced to investigate access via data centers located outside of China, a solution that lenders allegedly consider politically delicate. Jensen Huang, the CEO of Nvidia, stated that the business will continue to take strict measures to keep its technology from getting to unwanted customers. This position may influence how financiers assess risk associated with cross-border deployments. Banks may be considering future policy changes in addition to repayment risk because international authorities are always changing what is allowed. The White House is not exempt from this uncertainty. U.S. Commerce Secretary Howard Lutnick stated that U.S. President Donald Trump is still debating whether Nvidia should be permitted to sell cutting-edge AI chips directly to China. In light of this, PaleBlue.ai, whose founders started running the company in late 2023 and early 2024, is marketing itself as an AI cloud agent that provides safe and affordable computing solutions. Whether the finance lands or stalls could be a precursor to how lenders adjust to a world where demand for next-generation compute infrastructure is increasingly shaped by geopolitical calculations. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Your portfolio, but you said you want to consider investing in the picks and shovels of the AI trade in the industry. How do you feel about the market at this moment? Are you feeling positive?
I am feeling positive. I think there's a few headwinds ahead of us. Inflation seems to be creeping higher. Unemployment a little bit higher as well. We'll see what the Fed does with interest rates. So I think there's a few things that make it challenging for the consumer, which if it makes it challenging for the consumer, it's going to make it probably challenging for the market.
But at the same time, are you still a fan of the AI revolution? Because I know some of the picks you have are sort of correlated to that.
I am. I mean, it was interesting to hear you interview your last guest, Dan Ives, and talk about how much he loves NVIDIA and the AI trade. And I'm with him. It's fantastic. It's going to continue to grow. I think the challenge with something like NVIDIA is what we saw with earnings, this past earnings announcement, right? The very next day, the stock price went down a little bit. And while I'm confident they have plenty of sales ahead, they have seemingly ahead of the competition, even Google, with their announcement relative to their chips. What's not certain is that they're going to trade at the same multiples they did. And so when you saw that stock pull back after a beat, you understood that there's some weakness there. And so if you've been an investor in that position for a while this year, and you're thinking about trying to manage your risk, absolutely. We talk about investing kind of in what we call the picks and shovels of that industry, and not just that industry, data centers and crypto. So we're looking at the heating and cooling industry, which typically might be a little bit boring, but has done really, really well and is really the picks and shovels of that underlying AI economy.
Yeah, you like the HVAC ETF, and in there is Comfort Systems, Amphenol, and some of these names. I mean, Comfort Systems up over 120%, 100% for Amphenol. These are some names you like. Do you continue to like the HVAC ETF and some of these names?
I do. It's managed by one of your favorite portfolio managers, Dan Aarons, over here at Advisor Shares. And so absolutely, those are two of his top picks in that portfolio. As a group, the HVAC ETF is up a little bit over 25% this year. Now, that's less than the chip sector. If you look at SMH, I think it's the VanEck semiconductor ETF, that's up over 40%. But beating data servers as a group, beating, of course, crypto. Bitcoin's had a bit of a rough year after a strong start. So to get 26%, especially relative to the market, this is probably one of those areas where it feels a little value, a little old school blue chip. These are tried and true industries that are really driving the growth of what we're seeing with companies like Nvidia. So that's how we talk to advisors about it, is if you're getting nervous, if your clients are getting nervous a little bit about that, nothing wrong with taking some of those gains off the table this year and maybe looking at HVAC or the picks and shovels of that industry.
And then we turn to crypto. I mean, Bitcoin itself has been down about 20% this month. It's trying to claw back a bit now. I saw it at 90,000. You watch the IBIT ETF really closely. Tell me, is there opportunity there? Do you think the sell-off is an opportunity?
I do. Someone I watch a lot is someone named Mark Yusko from Morgan Creek Capital. And one of the things he talks about a lot is the history of the price action of something like Amazon and how it had, anywhere from 70 to 80, I think even at one point, 90% drawdowns, I think 3 different times over the cycle of that stock and of that company. And he always talks about, who's held it through all of that volatility. It's Jeff Bezos and, probably his family. And so when you have something that the fundamental story fits, it's technology that people seemingly are adopting, it's seemingly going to be a tool of the future. I'm not sure that I see it as a currency play per se. I think that if you are a Bitcoin fan and you believe in that story, I do think that you stick with it and you get these opportunities to buy in at these lower prices.
And then when I think about overall, I mean, you also have semiconductors and data servers, ETFs. Do you like both of those too, or are you just watching those?
I watch them more as we look at how the HVAC industry is doing, right? Those are the areas that are growing like crazy that the HVAC industry does support, but those have been weaker, right? The server data ETF, and I forget who runs that ETF, but the ticker symbol is SRVR. It's down, I think, 3% this year. So it's really been AI that's driving the returns. HVAC has been nice. And then you look at the commodities, because it's interesting, something like gas, which it matters to people, especially if you're driving to see your family this weekend for Thanksgiving, is down. But conversely, electricity's up, I think, almost a little over 4% this year. So, people are paying more for that. And that, I think, is, again, one of those things that are driving the HVAC industry. And I would point out a company that you just mentioned that is one of our top holdings, like Amphenol, and the ticker there is APH. They are the technology that connects those things, the hardware and the sensors to allow you to run those things more efficiently. So when you are seeing energy prices or electricity in particular going higher, that's where that company has really benefited by finding efficiencies really more at an industrial level, more than you might see in your home. And that's what really has driven strong returns for that company, which is up almost 100% this year as well.
You said you want to keep everybody's investments hot, even when, people are worried about the cold weather and all that. Do you see new highs? I mean, overall, do you see S&P 7,000? If so, when would that be?
I do, and I would be far pressed to give you a specific guess around that. But hearing what you interviewed with Dan Ives and him talking about, at some point interest rates will probably lower if it's not December with a new Fed chair going into next year. You've got an administration that is very focused. Their scoreboard, I believe, is in part the stock market. And so many people's investments, whether it's they're investing for their own in the market or it's their 401ks, are driven by it. I think you're going to see an administration that is going to drive things as aggressively as they can, whether that's all the investments that we are seeing being announced within the U.S., hopefully a lot of job creation around that, probably a lower cost of capital. It'll be a bumpy ride, but I would say that we are probably going to continue to head that direction. And the only reason why I probably wouldn't guess when we're going to hit it is because it definitely will not be a straight line. It's just a function of how investors are allocated and what they're willing to stomach from a risk perspective.